Good morning and welcome to 3 Minutes on Markets and Money. And of course, it is the post-Labor Day edition, as this is going to be a light trading week, right? 4 days in the week so far left. Already 1 day down, no trading yesterday. Markets hovering here right at all-time highs. A little bit of weakness on Friday after the employment report. However, this morning, bulls are kind of starting to get this idea that weaker economic data, which we're seeing, GDP estimates are being downgraded by Morgan Stanley, Goldman Sachs, even the Atlanta Fed. Now you're seeing weaker employment data. We've already seen a contraction in the Citigroup Surprise Index. What bulls are starting to think now, though, is that all this weaker economic data is going to keep the Fed from tapering. And looking at the fact the September meeting is rapidly approaching for the Fed, the hope here is that the Fed is going to announce more consideration about taper. We're going to be looking for a continuation of these reports. We need more time to evaluate. We need to reevaluate our thoughts on employment and the strength of the actual economy here before we start reducing our balance sheet. That's what the hope here is there'll be a change in tone towards the more dovish side of the ledger for the Fed. In the meantime, though, we continue this kind of upward bias in the markets, up 21% for the year. September tends to be one of the weaker months of the year. The question is, of course, can the bulls defy that weakness? They did a good job of it in August. August turned out to be a decent month, up over 2% for the month. Can they do it in September? Get you back into the seasonally strong period of the year, October, November, December. Tends to be typically strong. So without a correction here, this would be very much like the year of 2017, where we had an entire year of growth in the market, very low volatility, less than 1% of corrections during that period of time, and got us into 2018, where we had all kinds of volatility. Real possibility here, we could finish this year out higher than we are now. Hence, that's the article today on the website, realinvestmentadvice.com. S&P 5,000 analysts are rushing out right now to upgrade estimates for the market to S&P 5,000. Can we get there? Absolutely. Following the trend and momentum currently, we're well on track to get to that level. Not by the end of this year, but definitely by getting into 2022, we could see S&P 5,000. It's not that far away. However, as we cover in the article, the extensions from long-term moving averages, exponential growth trends, etc., are getting extremely elevated here. So the risk is that eventually we do get a corrective action in the market. When it occurs, what causes it, we don't know. It will likely be the Fed. And so that's really the thing to watch here over the course of the next couple of weeks. Watch the economic data, watch the employment data in particular, because that's what's driving the Fed decision making. And if the Fed starts to push out the idea of taper, that's going to give the bulls more support here, at least in the short term. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. We'll see you tomorrow.